Today, we will be discussing Chapter 8. These are risk management tools such as futures, options, swaps, and other hedging techniques that are used by financial institutions to reduce their interest rate risk on securities that they invest in. We call them derivatives. We will discuss short and long hedge. The short and long hedge are futures contracts. We'll discuss briefly options, swaps, caps, floors, and collars. Those are the different risk management tools that are used. We studied in chapter number 7 how do financial institutions manage assets and liabilities, loans and deposits to be specific. And as market interest rates rise or fall, we discussed what impact does that have on the institution's net interest margin. In chapter 8, we will be discussing the risk management tools, but only focusing on securities investment, not on loans or deposits. Many of the financial institutions, the largest institutions, are very active rather in derivatives. Approximately 15% of banks as of 2010 do deal with derivatives, and these are the different kinds of derivatives products that they deal with. Total face value of the derivatives was $225 billion. We already talked about the gap in chapter number 7. What is a financial futures contract? Futures contracts are associated with changes in expected rate changes, market interest rate changes. They are off-balance sheet transactions, please. Financial institutions need to what is known as mark-to-market these derivatives. What that means that every day they need to revalue the actual value of the derivatives once they close out the position in 24 hours. So daily they need to revalue it, means they need to determine the market value of those derivatives based upon market interest rates on that given day. And as the rates change, so does the market value. Futures contracts. Buyers of the futures contract and sellers of the futures contract. A buyer of a contract is said to be a long future, means they are dealing with long futures contract, while the sellers of the future contracts are known to be taking a short position, and they are said to be short futures. More on that in a little while. Futures contracts are also traded over the counter, but majority of the contracts are traded through the exchanges. Forward contracts are typically related to foreign exchange. We will focus in this chapter on futures contracts only. The most common assets that are used to base the value of the derivatives, the definition of derivative, by the way, is the value that is derived from. How are the values for the derivatives derived from? They derive from the actual value of the bonds, euro dollars, Fed funds, or LIBOR futures contracts. For example, as you all know, that if market interest rates rise, bond values will fall. As market interest rates rise, euro dollar time deposits values fall. As market interest rise, Fed funds futures contracts falls. If market interests fall, treasury bond values go up. They behave inversely. So that's why financial institutions use these assets, underlying assets, which can be valued and measured given the change in interest rates to determine if the financial institution is profiting or losing money on that particular futures contract. Futures contracts are basically identified in these denominations. If you look at any financial newspaper, more on that when we look at the problem. Let's discuss short versus long futures contracts. What is a short futures? A short futures contract is associated with expected rise in interest rates. So if interest rates rise, the value of the futures contract will fall. Again, if interest rates rise, the values of these securities will fall. In the case of the short futures hedge, one institution will buy a contract today when rates are low. When rates are low, the value of these securities, again I'm going to go back to the securities, when rates are low, the values of these securities are high because they behave inversely. So today the values of the securities are high based upon current market rates. If market rates were to rise, which they are expected to rise, the values of the securities will fall. What the institution will do is sometime in the future, they will buy the same securities on the exchange now at a lower rate because of the fact that market rates have risen. These institutions are trying to protect themselves from rising market rates. They would be involved, they would get involved in short futures contracts. So today they will buy the contract. It's a hypothetical contract whose underlying value, by the way, is dependent upon treasuries or euro dollars or Fed funds. The hypothetical contract value is dependent upon that. Because rates are low today, the values are set high. The institution will go out in the futures contract and sell it at the current price, at the higher price. When market rates rise and the price falls, they will turn around and buy now. They will buy this contract now through the same exchange at the lower price. And the difference between the purchase price and what they sold it at results in a profit. That profit offsets the loss in the value of the securities because they're still holding the securities. When securities that they hold, values fall because market rates rise, they will hedge against that, go out and buy a contract for the same amount of the securities, sell the contract at the higher price, buy it later on at a lower price when interest rates have risen. And once the contract expires, they cancel out and the institution will generate a gain. Now, if the market interest were to fall instead of rise, they will lose money. But it is better to at least hedge than not hedge. So gain would result if the market rates were rise, if they were right, rates do rise. A loss will result if market rates were to fall. This is a very important concept. This is the key concept in this chapter. This is a hypothetical contract that they would buy later on when the prices fall. What is a long hedge? Long hedge is just the opposite. It is associated with expected fall in interest rates, expected drop in interest rates, not rise, but the drop. Short futures are with rising rates, long futures falling rate. Today, because rates are high and they are expected to fall, the securities values are lower. So the institution will go out and purchase a contract at the lower price to the exchange. Because rates are high, they are expected to fall. When interest rates are high, the values of the securities are lower. The futures contract is priced low. They will buy it today at a low price. Sometime in the future, interest rates fall. As rates fall, the value of the futures contract will rise. As the contract price rises, they will then go out and sell that, resulting in a gain. So in the case of the long futures contract, the first step is that the institution will first buy it at a low price and sell high. Any investment, you buy low, sell high. So please keep in mind, in the long contract, the first step is to buy, the next step is to sell. In the short contract, short hedge, the first step is to sell, and then the second step is to buy, just the opposite. Why do they hedge? To avoid rising costs, to maintain the returns on the security holdings, because as market rates rise, the values of the securities fall. Those are the reasons why they hedge. Basis risk. This is the risk associated with the actual value of the contract itself. We will discuss this when we go through the problem at the end of the chapter. We will also discuss the profit or the loss on the hedge when we go through the example at the end of the chapter. Please keep in mind that these are just illustration formulas. You will not be responsible for equation number 3, neither you be responsible for 4 or 5 or 6. These are only for illustration purposes. We will go through the mathematical calculations when we look at the example at the end of the chapter. Neither are we responsible for the long hedge formulas. The previous formulas were on short hedge. These formulas are on long hedge. We are going to skip over certain slides. Please keep that in mind. The slides that are not required are 21, which is on duration, 22. Let's talk about 23. This is a graphical presentation of what is known as a short hedge with expected rising rates, and long hedge expected fall, dropping rates. This is rates declining, this is rates rising. Rising rates are associated with the short hedge, declining rates are associated with the long hedge. Let's take a look at graphically what we just talked about before. If market interest rates were to rise, this is the price of the security today, F0. As market rates rise, the securities values will fall. So this particular graph will go to the left. This is a shaded area. The institution will sell the security rather, they'll first sell the futures contract at this price. When market rates rise and the securities fall, they'll go out and buy it at a lower price. They would purchase it at a price lower than what they sold for, resulting in a profit. The more the price falls, the more the interest rates rise, the higher the fall price. Prices fall, the higher the profits. So now first they will sell it at this price. F0 is the sell price, Fn is the purchase price. As market rates rise, values fall to the left, results in a gain. In the case of the long hedge, it is just opposite. Rates are expected to fall. If interest rates fall, securities prices rise. So today, F0, the institution will buy the security at a lower price because rates are low. Rates are rather high, sorry. When rates fall, when rates decline, securities values will rise. So today rates are higher, they are expected to fall. As rates fall, the values of the US Treasuries or all securities rise. They can then sell them at the higher price, FT, resulting in a profit. So again, please keep in mind, long hedge is associated with interest rates expected to fall, securities are expected to rise, going to the right. Short hedge is associated with expected rise in interest rates and a fall in security prices to the left. 24 is not required, neither is 25. Let's look at options. What are options? The difference between interest rate options and interest rate futures contracts is that interest rate futures contracts are binding. What that means is that they cannot change their mind. I'm going to go back and these contracts, short and long futures contracts, once the institution agrees to sign them, they cannot change their mind. They have to follow through with that. So futures contracts are binding contracts. They cannot change, they cannot reverse it. However, options are, as the definition implies, you have the right but not the obligation. The futures contracts have an obligation, options do not. That's the key difference between options and futures. If the institution expected market interest rates to rise, and I'm going to go back to the short hedge. If they expected market rates to rise, and if market rates do rise, securities prices fall, they can gain. However, if market rates do fall instead of rise, they will lose money. So it's either a gain or a loss because these are binding contracts. In the case of options, they have the right to cancel if interest rates were to go down instead of going up. What are put and call options? Let's compare that against short and long hedge. Again, please keep in mind that options, in the case of options, institutions also use the same underlying securities, bonds, euro dollars, etc., to determine the underlying values of these derivatives. They are recorded in the newspapers. Most options today are used by large institutions to hedge against positive or negative gaps because of changes in interest rates. Let's take a look at options graphically. This, on the right-hand side, is a put option. A put option is a right to deliver. A put option is to protect against rising interest rates. If you recall, in the short futures contract, expected rise in interest rates was associated with the short futures. Expected fall in interest rates was associated with the long futures contract. So please keep in mind, short futures contracts are the same as put options. The difference is that options can be canceled, futures contracts cannot be canceled. Long futures contracts, they are associated with declining interest rates. They are known as call options. So call options are long futures contracts if interest rates are expected to fall. Put options are short futures contracts where interest rates are expected to rise. Let's display this graphically. Again, this is S is the strike price. In our previous example, we had F0. And I'm going to go back to that graph, please. In the short futures contract, we had F0 and the value rising to Fn. If market rates fall, or rather rise, values will fall as market, because we expect rates to rise. And as the values fall, there is a profit, because they sold it at a high price, sell it at and buy it at a lower price. The same, you'll see that for the options. The profit is rising. This is the strike price. This is the price that they expect to sell it for. As interest rates rise, securities prices fall. And as securities prices fall, the profit rises. Here, we have the same thing. This is a long hedge, or called a call option. Strike price is the purchase price. As interest rates fall, as interest rates decline, prices rise, they buy it low, sell high, generate a profit. So these are very similar to the short and long futures contract. This is the same graph except from a different angle. 32. There are some accounting rules that must be followed when financial institutions record these options and futures contracts. They must be off balance sheet. They must be marked to market, means they need to determine the value of these every day, and they do need to report this on their balance sheet each day. The OCC is the Office of Currency and Controller. This is the US regulators. They want to make sure the fact that the financial institutions limit the amount of derivatives they invest in, and therefore they do supervise and audit the financial institutions periodically. Slide number 33 is not required. This is more accounting, Financial Accounting Standards Board, or International Accounting Standards. This is only for the accounting purposes. Slide 34. Let's talk about swaps. Interest rate swaps are hedging techniques. Here the institution is swapping a fixed interest with a variable rate interest, or a variable rate interest with a fixed interest security. So if the institution believes the fact that interest rates are expected to rise and they are holding a fixed rate security, instead of selling their security, they could actually swap it, means exchange it through a third party. And therefore, they would exchange a fixed rate for a floating rate, which is variable rate, so that as interest rates rise, their interest income rises to protect themselves. Interest rate swaps are also swaps from a fixed to a variable rate, or a variable rate to a fixed rate. If the institution is expecting market rates to fall, decline, and they have a variable rate security where they will lose interest as market rates come down and value of the securities will fall, the returns will fall, they could easily swap that through a third party with a fixed rate. By swapping from a variable rate to a fixed rate, they will earn a fixed interest rate on that particular security. So this is simply a swapping. Please note, when the interest rate swaps occur, we are only swapping the interest, not the principal amount. The institution continues to keep the securities. They're not selling the securities. All they're doing is they are minimizing their interest rate risk by swapping fixed to variable rate, variable to fixed rate, depending upon the direction of the future interest rates. There are also other more complex swaps. This is not required by the slide is not required. This is a graphical presentation of a swap. Please review this in the textbook. It gives you more information. What they do is that the fact that one institution will swap with another institution through a third party. Swaps are rated by Moody's, Standard & Poor's. Let's talk about caps, floors, and collars. These are three additional risk management tools that institutions use to a lesser extent. Most of the hedging is on futures contracts and options. They do interest rate swaps, but very little. And they also do caps, floors, and collars, but at a lesser extent. What does caps, floors, and collars mean? What is a cap? And by the way, these formulas are not required. All you need to be concerned about is the definition. An interest rate cap is where the bank is going to agree to the highest interest rate charged on a loan to a business. If the business is concerned about rising interest rates on a variable rate loan, what they will do is that they will ask the bank to maximize the rate, and in return the business will pay a fee to the bank. For that fee, the bank will cap the rate. Means if interest rates rise, they will not rise beyond the cap. So the business is protected, and their interest expense does not go up. So as market rates rise, once the rate reaches the cap, interest rates will not rise, and it protects the company. So an interest rate cap is to protect the company, and they can buy a cap and pay a fee to the financial institution. What is a floor? A floor is just the opposite. Again, you're not responsible for the formula. The floor protects the bank, not the company. If interest rates were to fall, the bank will earn less interest. What the bank is going to do is ask the company to sell them a floor. So the company is going to sell the bank the floor being the lowest rate. So once the rate falls up to that point, the interest rate that is charged to the company will not go down anymore, and therefore the bank will earn a fixed interest rate until rate starts to rise again. So it protects, a floor protects the banks from lowering revenues, and therefore the bank will pay the company a fee. So when the company sells the bank a floor, the bank pays the fee because it protects the company. When the company purchases a cap from the bank, it protects the company from rising rates, and therefore the company pays a fee to the bank. A floor is to protect from dropping rates, from declining rates, where the bank is going to pay the fee and it protects the bank. What is a collar? A collar is a combination of cap and a floor. You see, interest rates are unpredictable. They could go up or down throughout the term of the loan. In the case of a collar, the company and the bank are both involved in protecting their revenues or expense. The company wants to minimize interest expense. The bank wants to maximize interest revenues. Therefore, the company will buy a cap from the bank where the rate will not go any higher than the cap, and the bank will purchase a cap from the company. The company will sell a floor. So there is a combination of a cap protecting the company and a floor protecting the bank together. That's a collar. That's a collar. So the interest rate will only float within that collar. It protects the company if rates rise. It protects the bank if rates fall. That is essentially the chapter. What I'd like to do next is review with you the problem that is at the end of the chapter. There are two problems, number 8.4 and 8.5. Please review these problems very carefully. There is some calculations involved. There are no equations or formulas required here. In this case, what we have, the problem is as follows. A bank wants to borrow $500 million. A bank wants to generate $500 million in deposits, new deposits, for 6 months, 180 days. However, they don't need the deposits today. They need the deposits 3 months from now, in the future. However, in the future, rates are expected to rise to 4.5%. So what the bank is concerned is that by the time they go out and provide the deposits, they will end up paying 1% more interest. Today, rates are 3.5, but they do not need to raise the deposits today. By the time they raise the deposits, rates have risen to 4.5. So the bank is trying to protect itself from rising interest rates, from 3.5 to 4.5%. The question is, what is the basis risk? This is known as the basis risk, which is called the cash risk. We looked at that. One of the slides we looked at was talked about basis risk, and I said that we will come back to that when we review the problem. So in this case, what we asked to do is to calculate how much higher interest expense, which is 1% of $500 million, that the bank will incur for half a year, 6 months, because the term of the deposits are only for 6 months. They are 6-month deposits. So if they could issue the deposits today at 3.5% on $500 million for 6 months, 180 or 360, please keep in mind we always divide by 360, not 365. Then the interest expense will be $8,750,000. However, if interest rates were to rise, as the bank is expecting rates to rise to 4.5% on $500 million for 180 days over 360, the interest expense will rise to $11,250,000. Therefore, the bank will experience a basis risk, a cash risk of $2.5 million higher interest expense. So interest expense will be higher because they wait until rates rise. As you know, if market rates are expected to rise, the bank can protect itself by pursuing a short futures contract. So in this case, the bank is looking to pursue a futures contract. Rising interest rates or expected rise in interest rates are associated with a short futures contract. Falling interest rates, expected decline in interest rates are long futures contracts. Rising rates are short. So because rates are expected to rise from 3.5 to 4.5%, the bank is going to protect itself from a hedge, and this is known as a short futures contract. If rates were expected to fall, it would be a long futures contract. Let's go to number 5. In this number 5, what we are asked to do is determine what is the profit on the short futures contract on $500 million. So these two problems are related. The bank is trying to offset the $2.5 million additional interest expense. They will pursue a short futures contract. To do so, the bank is selling 500 contracts. Each contract is $1 million, and therefore 500 contracts times $1 million is $500 million, which is, by the way, the exact amount of the deposits. So they're trying to hedge $500,000 of deposits with higher interest cost by offsetting with a short hedge for $500 million, which is 500 contracts, each with a minimum of $1 million. Now, today, as you know, in a short hedge, the step number one is they will sell. And then, step number two, they will buy back. So today they will sell, and when market price rise, because they expect to rise, the price drops. They will go out and buy low, sell high. They sell high today, and when market price rises, values fall, they will buy at a lower price. And by selling at a higher price, buying at a lower price, they make a profit. That profit or gain will offset the higher interest expense. So our task is to determine how much of the $2.5 million higher interest expense is the bank able to profit back. Let's do the calculations, please. Again, $500 million. Today, they sell it at an index of 98. This is 98.0. This is how futures contracts are priced. 98, by the way, is simply 0.98. All we need to do is take the decimal place and move it to the left by 2 to do the actual calculation. This is how the financial markets report that. 100 is 1. 98 is 0.98. If this was 102, 102.0, then this will be 1.02. Okay? So in this case, we have to move the decimal place 2 to the back, to the left. We multiply $500 million, which is 500 contracts, each with 1 million, times 0.98. And by the way, this futures contract is only for 90 days. Now, keep in mind, please, that the contract does not have to be for 180 days, even though the deposits for 180. They don't need to be the same term. They are two different transactions. So what the bank is trying to do is trying to hedge a 180-day deposit with 90-day contract for 3 months. So we need to prorate it, please. 90 always divide by 360. $500 million times 0.98, which is the sell price, times 90 over 360 is $122,500,000. And this is the sell price. Now, interest rates are expected to rise. If interest rates rise, the value of this contract will decline. Inverse relationship, if you remember. Rates rise, bond prices fall. So now the index price has declined from 98 to 96.98. Rates rise, values decline. We multiply the $500 million contract times 0.9698, because we're going to move that to 2 decimal place to the left, times 90 over 360, prorated. The institution will buy the same contract that they sold for $122.5. They will now buy that same contract for $121,225,000. So they sold it at a high price. When rates rise, values fall, they buy it low, at a lower price. The institution is making a profit of $1,275,000. So the pre-tax profit on the hedge before income tax is 122,000 or 122,500,000 minus 121,225, and this is the profit pre-tax. So because market rates rose, the bank was correct. It did make a profit of 1,275. Now, the next thing you'll be asked in the exam, please, this is not something that the author is asking, but please do include this. This is something you must know because you'll be asked in the exam. The question is, what is the net profit or on the overall position? The net profit, by the way, is the difference between $2.5 million expense, interest expense, higher interest expense, offset by $1,275,000 profit. So this is the higher interest expense, profit on the hedge, and therefore the institution has lost $1,225,000. Now, you may ask, why bother hedging if the institution is going to lose money? Well, my question is, what if the institution had not hedged? If the institution had only done problem number 4, how much would they lose in higher deposit rates? The institution would have lost $2.5 million in higher interest expense if they did not hedge. By hedging, they were able to recover $1,275,000 from the hedge, and therefore their loss is reduced from $2.5 million to $1.225. It is always important to hedge, even though it may end up being a loss. By not hedging, the institution will have lost $2.5 million. So they're trying to minimize the risk by hedging, which generated a profit, and therefore the loss is reduced. The worst thing that management can do of an institution is do nothing at all. That concludes chapter number 8.